Yes, good afternoon once again. So last week,
And we say they want to again to the can work.
okay, can you reach out to Onye or Tony or someone of them? All right, thank you. So we started last week with demystifying statement of cash flows. And I hope it was a rewarding time last week. So this week we'll start with actual preparation of statement of cash flows. That's what we'll do today with the 2 hours that we have. Wherever we stop at 5 p.m., we drop our pen. But the remaining curriculum or remaining part I have to cover, I can probably just record it in outside of the webinar and maybe share. Because by 5 or 5:15, I have somewhere to go. So let's see what we can achieve within the next 2 hours. So last week, in summary, we learned about, this is my face. We learned about the SCF mechanism, the statement of cash flows mechanism, where we talked about the bottom up and the top down mechanism, where we said everything starts with an idea. You fund the idea by raising the capital required. After you raise the capital required, you invest the money you raised. And from investing the money you raised, you can start operating the investment, which is usually an asset. We used Dangote as an example, who had an idea some years ago to set up a large conventional refinery. He went to get the funding and used the funding to construct the refinery. And afterwards, he started operating the refinery for, I think, almost 2 years now, if not more than 2 years. And that's it. That's how it works with any business you see out there. There's always an idea or a change in strategy that must be funded. And afterwards, you then execute and operate the idea. That's the SCF mechanism. And we said the operating activity is the most important. If it fails, every other thing will crumble. You will not be able to pay back the money you raised if the operating activity fails. It's so important that there are 2 methods for presenting the operating activity, as we saw last week: the direct method and the indirect method. Last week, we also talked about the concept of cash and cash equivalents, where we said that for something to be referred to as cash, the company should have access to it for the purpose of short-term and working capital commitments. It must not be restricted. That was the major point last week. We dealt with 1 or 2 examples here and there to run in that principle. For cash equivalents, the most important thing, apart from it being available for working capital requirements, we said cash equivalent it should be subject to insignificant risk of changes in value. So the likelihood of it changing in value rather so significantly is low. And that's why an investment like a Bitcoin or anything related to cryptocurrency would likely not be referred to as a cash equivalent, because we all know how much that asset fluctuates in value. It can be 1 naira today, or in 1 minute's time, it can become 50,000. Just giving an example, it's very volatile as an asset. So you might not find it under the bucket or umbrella of cash equivalent. Preparing the statement of cash flows. The 4th one, which is the common pitfalls, time may not permit, so we might just focus straight on preparing the statement of cash flows. So allow me to ask you again, can you hear me clearly before we start preparing the statement of cash flows? Can you hear me clearly? Please confirm you can hear me by sending a Y to the chat box, because we're about to go into the more sensitive aspect. All right, thank you very much for responding. The turnout today is not as much as last week, but it's fine. Let's proceed. So we want to go into the preparation of statement of cash flows right away. I need you to follow me very closely, please. On your screen, it's an hypothetical company. This is a complete financial statement of a company called Intelligence Small Limited. We have the cover page, the table of contents. It's just complete. It's all complete. What is just left is the statement of cash flows. But by the side, the statement of cash flows, I've already prepared it. This is the complete look here. This is the indirect method and this is the direct method. So at the end of the day, if we don't complete it at 5 o'clock, the stoppage time for this session, this document will be shared with everyone. So you can just go through how it was done. But as much as possible, the underlying principle, we will share it. You will get to understand it before 5 o'clock. So if you are ready, I'm ready. Let's go. We'll be applying what in Accounting Yard we call the CAMPS framework. CAMPS framework is a step-by-step framework. Let me see if one of these sheets have the CAMPS framework. Here it is. So wherever you are, I will like you to repeat after me. The completeness and accuracy of my statement of cash flows is driven by how much I can correctly drill down into the movement in the statement of financial position items. The more I can drill down into the movement, the more accurate my statement of cash flows will be. So let's take it one by one. Step 1 is to calculate the difference between the current year and prior year for each statement of financial position item. Let me project this presentation. This document, I believe we all have it now. I shared it after our session last week rather. Okay. Before we go into that, I think some basic items we must put in place first. You must ensure that your balance sheet balances, and you must ensure that your notes are as detailed as possible. And as you prepare, you start finding loopholes in your notes. So these two basic, the first one is the most basic. So before you start applying the CAMPS framework, check if your balance sheet balances. That's your statement of financial position. If it doesn't balance, find a way of fixing it, because if your balance sheet does not balance, your cash flow will not balance. So if it doesn't balance, your cash flow will not balance. So the foundational principle here, like I mentioned, the completeness and accuracy of my statement of cash flows is driven by how much I can correctly drill down into the movement in SFP items. SFP is Statement of Financial Position. So here is step 1. Calculate the differences between prior year PY and current year balances for each item in the SFP. That's step 1. So we want to start preparing the statement of cash flows now. We have checked our balance sheet balances. We are happy that it balances. We're happy it's fine. So step 1, let me go back to our Excel document. So the difference between last year and this year. For assets, you can do it just by the side here. If you have prepared your statement of financial position completely, just a rough work by the side here. So I would say equal to, for assets, it is prior year, which is 2023 here, minus current year, 2024. So for assets, when you are doing this movement in balances, it is prior year minus current year. I can drag it down. I can copy this same formula and apply it to these other assets here. Control V. So these are the movements in the balances for each asset in my balance sheet. You will do the same, but in an inverse manner for your equity and your liabilities. So for equity, it is current year minus prior year. For asset, we said it is prior year minus current year. For equity, it is current year minus prior year. So I can drag this down. Just copy any of this formula so that I can replicate it for non-current liabilities and the current liabilities. By so doing, just scrolling down to check once more again. Yes, balance sheet balances. So by so doing, we have determined the movement in each of the balance sheet items. I think for the sake of easy navigation, I will need to freeze this top. So go to view, freeze pins, yes. One way for you to know that you have done the correct thing in step one, or you have done something wrong in step one, once you are done with the movement, the calculation of this difference between prior year and current year, you highlight everything. Highlight everything. If it does not give you 0, then there is bins. I mean, there is error. So you see here, when I sum up all this movement, you can see that the sum is 0. If it is not 0, or if it is not something minimal, maybe decimal, 0 point something something, then there's an error in what you have done. Sometimes some people, when they get to liability, instead of saying current year minus prior year, sometimes one may mistakenly say prior year minus current year and just, mess up the whole thing. And that may cause it to be 0. So you must check it. Once the sum is 0, your step 1 is fine. I pause again. Is step 1 clear? You can send me a chat into the chat box. Is step 1 clear? Step 1 is simple. For assets, by the side, do a current year, do a prior year minus current year. Thank you very much, everybody who said yes. Priscilla said no, I don't know why. And Taiwo Vic said no, I don't know why. Let me hear from them why they have said no. Starting with Priscilla. Somebody is asking, what if the current liability has everything on that liability is current year minus prior year? You can see for yourself that the borrowings has current portion and non-current portion, and yet we still did the current year minus prior year. As long as you have prepared your SFP, you are done and dusted with your SFP. Step 1 is what it is. It has nothing to do with preparation of SFP. It's more of using the SFP than preparing the SFP. Let's take note of that. So the SFP is already done and dusted. Step 1 is simple. Let me do it again. Equal to, for assets, prior year minus current year. And then you can drag down and replicate for all the assets. And for liabilities, is the opposite. Current year minus prior year. And you can drag down to the other line items. It's probably the simplest part of this step. Somebody's asking why is the rule for asset different from the rule for liabilities and equity? That's simple, because remember, your double entry, when asset is increasing, it goes to the debit side. When liability is increasing and when equity, they are increasing, they go to the credit side. Those accounts have different double entry dynamics. That is why when you get to assets, you will say prior year minus current year. And when you get to liability, you say current year minus prior year. Because of the different double entry dynamics, that's why you have that opposite direction type of movement in financial position. From a cash flow standpoint now, what this means is that you have purchased more assets. Before it was 1.4 billion, now it is 1.69 billion. So you have purchased more assets. And if you purchase more assets, cash must have gone out. So there will be an outflow. That's why you find that this difference is in negative, saying that there is an outflow. That's just how cash flow will read this movement in the assets. So that's why it's important for you to get the direction. For assets, it is prior year minus current year. And for liabilities, it is current year minus prior year. Step one is pretty much the simplest of everything. My 2-year-old daughter can even do step one. That's on a lighter note. I'm not sure she can do step one. I'm just joking. So that is step one. Let's go and check out step two. Let's go and check out step two. Step two. If you are wherever you are, if you are in your room, if you just read it with me. Obtain the breakdown for each of the differences by making use of the notes to the financial statements. Obtain the breakdown for each of the differences by making use of the notes to the financial statements. Now, what does this mean? I come back to my statement of cash flows. The first guy here is property, plant, and equipment. I want to know what makes up this 268 million. What is inside? That is what step two is saying. Right of use assets, it's reduced by 6.6 million. What is inside that 6.6 million? Some things have happened during the year that has moved all these balances from this point to this point. I need to know those things because those things may fall into what they call the camps. So starting with 268, the best way to know what is inside this 268 is to come to note 17 here. Note 17. Note 17. So I will look for note 17, which is this. This is note 17. You see, note 17 breaks it down. It said for PPE, you have what they call cost. This is cost here. And you have what they call accumulated depreciation. So that cost minus accumulated depreciation will give me what they call the carrying amount or net book value, as some older folks will call it. So between last year and this year, let me start with cost. What happened with cost? Between the beginning of 2024, the end of 2023, remember the end of 2023 is the same thing as the beginning of 2024 in accounting. So the beginning of 2024 to the end of 2024, the first subsection under property, plant, and equipment is cost. What happened there? Why did it change from, look at it, 1.95 billion to 2.34 billion? The answer is here in the notes. During that year, we had additions worth 456 million. We had revaluation surplus worth 21.6 million. Reclassification, well, charged nil effect, and we have disposal, 87.23 million. So these three pretty much made up the movement in the cost. If I come to accumulated depreciation, what made this accumulated depreciation move again from the beginning of 2024 till the end of 2024? It was 525 at the beginning. It's 647 at the end. Look at the things that made it move. Charge for the year and disposal. Voila, I have a good sense of what happened. I have a good sense of the items that are inside this 268 million now. I now have a good sense of it. That's step 2. Step 2 is simply saying that this breakdown you got in step 1, go to the notes, note 17 here, and fish out what happened during the year. So we have seen what happened during the year. There was charge for the year, there was disposal, there were additions, there was revaluation surplus. Those are the things that happened during the year. So step 2 is fine. I've seen them in the notes. We can now go to step 3. Before we go to step 3 again, let me pause. Any questions or comments? Any questions or comments? Feel free to raise your hand up. Chukuka Njoku. I hope I pronounced that correctly. Forgive me. Chukuka, you have the mic.
Yeah, good afternoon, sir.
Good afternoon.
Yeah, thank you for the opportunity. Can you do the same exercise for step 2 for another item on the SFP? We just want to get a better understanding.
I love that
Maybe the
question.
ROU asset, yeah.
Yeah, even the ROE is pretty straightforward. Let me do it for borrowings. The ROE is pretty straightforward because ROE is just like PPE too. So let's say for borrowings, this is the borrowings. So you have 424 closing balance under non-current and 261 under current. So if we go to 2020, note 27, we'll see what moved that borrowing. So the total movement in borrowings is 76 under non-current and 151 under current. So that means the total is 228 million. Mr. Chukuka, are you still there?
I'm with you clearly.
Great. So you'll see that borrowings, the total movement is 228 million. Then in our minds, we'll be like, what is inside this 228 million? The note can answer it. We then go to note 27. Here is note 27. This was the opening balance. This was the closing balance. So it means that this point to this point are the movement. So if I highlight all of this, you can see it's the 228. Can you see it?
Yes, exactly.
Perfect.
Thank
So that
you.
is how each of those movements are. By the time you are looking at a movement and you can't trace it to your note properly, then it is signaling to you that something is wrong with your notes. That's why I like statement of cash flows as well. It will help you sense check the storytelling in your note, because your note should tell us what happened during the year to a large extent. And statement of cash flows is simply telling us how we spent our money during the year. So the notes should expose that as well. So by the time you start doing this referencing from that movement to the notes, you start seeing bins, errors, loopholes, incompleteness, inaccuracies in your notes. And as you are seeing them, be correcting them. Thank you for that question. Yes, the Excel will be shared. Don't worry. Just follow me. Just follow me. Don't worry. It will be shared. I promise you. Any other? Why does it not show the exact movement in the SFP? It won't, because the SFP it aggregates a lot of transactions. So it's just a summary, but the notes will now break it to say, this is what was at the beginning, this is what was at the end. Okay, what made those 2 points different? It will now run you through that journey. That's what the notes does. Except I don't understand your question, my friend, Mr. Adidayo. Mr. Akim said, are you saying the movement is what causes the difference in the PPE? Perfect, exactly. That's what causes it. Thank you, Mr. Emmanuel. Mr. Godson, I want to believe it's a Mr. How will one know what caused the difference on retained earnings? I like this question. I like the way you guys are now thinking. If you want to know what caused the difference in retained earnings, there is a content of financial statement called Statement of Changes in Equity. If you go there, you will see how equity has changed during the year. Some persons may even prepare notes for retained earnings. I think we did that in this FS. Yes, look at it. This is a note for retained earnings. You can see what happened during the year under retained earnings. In icon class theory, if you want to know what happened during the year, you will find it in the additional information. But thank God we are off that. We are doing practical stuff here. So if you want to know what happened during the year from a practical standpoint, the notes should tell the story. The disclosures should tell the story. That's the whole idea. Remember, step 1, difference between the two balances in the balance sheet or in the SFP. Step 2, what is inside each of those differences? What is causing those differences? Why was the balance 347 last year and it's now 424 this year? Remember, where will you find that answer? In your notes. By the time you start scouring through your notes and you can't find the answer, it's pointing you to one thing: your notes is probably not well prepared. That's one thing I've observed, practically speaking, when preparing statement of cash flows. What may be the reason why the SFP will be balanced but the SCF will not? Because the person preparing the SCF probably does not know how to prepare it. That's one reason. That's one easy reason. Because once your balance sheet balances, the SCF should easily balance. All right. Let's move beyond step 2. Let's go into step 3. Follow me closely. I don't want to miss you. Let's move to step 3. Wherever you are, read with me. Classify each of the items in the breakdown into any of the camps. So what we did in Accounting Yard was to say there are a handful of items that can make their way into the statement of cash flows. Not everything in the financial statement will make its way to the statement of cash flows. There are a handful of them. We now thought about it. How can we create a structure of those handful of them? We now came up with the framework camps. We structured them into 5 categories. Once you find an item that falls into any of these 5 categories, most likely that item will find its way to the statement of cash flows as either operating, investing, or financing. So the camps is the structured category of items you should push to the statement of cash flows. So let's go. What's camps? What's camps? Let's see what's inside the camps. The C stands for cash outflow or a cash inflow. Earlier, Mr. Chuka asked a brilliant question. He said we should pick a line item and we pick borrowings and we trace the borrowings to the notes. 228 million was the movement. We found out that 228 million, let's go and check. That notes 27, I think. Here it is, total borrowings down here. Perfect. So these are the items. Let me paint them in blue, Accounting Yard color blue. Yep, blue. So these items here make up the 228 million that is making the borrowings move from the balance at the beginning to the balance at the end. The first item is 366. It's an additional borrowing. So I want to ask you, when you borrow more money, will you have inflow into your bank account or outflow into your bank account? What do you think? You can reply me in the chat box. When you borrow more money, the borrow people here, we have some of them here, they like borrowing. Do you have such inflow or outflow? Yes, thank you very much. Most of the time it's inflow. You know, when you borrow money, it's very interesting to collect the money. It's now when it's time to pay back, while I go start. So that's why most of you can get that inflow part. Some people, once it enters, it's not going out again. Bad character. But that's by the way anyway. So inflow, 366. So that means if I want to classify this 366 million in the camps, it will most likely come under C, cash outflow or inflow. In this case, it's an inflow. So that's the first one, C, cash outflow or cash inflow in the camps. Remember what we called the camps, the broad category of items that you can find in the statement of cash flows. So when somebody says he wants to take something to the statement of cash flows, you ask yourself, is it part of the camps? If it is not, then you must double check the accuracy of that thing. The second one, A, adjustment for non-cash item that was used in deriving profit. Not in deriving OCI, the non-cash items used in deriving profit. Let me give you an example of that. All these things will still apply them holistically, but I'm just taking them one by one as well. So if I come to my statement of cash flows, I've written this down already for us to be faster. And I have my operating activities, for example. If I'm using the indirect method, the first thing I will start with is profit. Let me start with profit for the year. Last week, we learned that you can start with any profit. The standard did not specify. But in practice, you find most people start with profit before tax. But I like starting with profit for the year. So profit for the year, for example, for this, our hypothetical company, I will just link it to the profit for the year, which is in this income statement here, 185,691. So A is saying that, remember we learned that profit is not cash. A is saying that what items have been used in getting this profit, but those items are not cash. And we need to adjust for those items. That's what A is saying. And that will bring us to that category called adjustment. A popular example here is depreciation. So once you find an item that was used in getting this profit, but it is not a cash item, then that item will come under the adjustment. And how do you find all these items? Go to your notes. Your notes is explicit. You can start with, okay, how was this profit derived? You come to your income statement. This profit was derived from all these figures that came before. So you start checking each of these figures one by one, searching for non-cash items one by one, searching for them. Once you find a non-cash item, you bring it under this adjustment category. Remember, A, any item that was used in deriving profit, but that item is not a cash item. That is the category A. That is the category A. That is the category A. Don't worry, the recorded version will be shared. Don't worry. Last week's one was shared, so rest assured. A typical example is depreciation. Depreciation is inside these administrative expenses. I know it because I prepared it. And these administrative expenses was used in deriving this profit for the year. So that means I need to adjust for it by adding it back because depreciation was deducted as if it's a cash item, whereas it is not a cash item. So I need to add it back. So category A, items used in deriving profit, but are not cash movement related items. We call them adjustments. That's category A. Then M, this is the simplest. Movement in working capital. Working capital is current assets minus current liabilities. Anything under current assets, anything under current liabilities, there is a place for them in the statement of cash flows. You would find it under the operating activities. So you have a special segment for them called, let me just put it here, movement in working capital. So that's the M. It's the easiest because if working capital is current assets minus current liability, if I come to my SFP, all these movements in inventory, trade and other receivables, advance, these three like this, that are under current assets, I will just bring them and dump here into my statement of cash flows. Those ones are easy to spot. The M category, they are the easiest to spot. Movement in working capital. Then the P, which is easier. Profit or loss. Profit or loss is also part of the CAMS. It's a typical thing you will find in the statement of cash flows, profit or loss. If I come to this statement of cash flows, the first line item here, look at it, profit for the year. So it could be loss as well. So it's one of the categories of items you will find in the statement of cash flows. Then the last category is S, specific disclosure requirements. So there are some cash flows that statement of cash flow we want you to show visibly on the statement of cash flows. These ones they are just balancing figures. They are the last set of items we usually just show so that they will know that we paid interest, so that they will know that we paid dividend. So to achieve them, most times they're usually in and out. They don't usually affect the balancing of the statement of cash flows. We'll remove them from one place and add them in another place. Another easy category to bring into the statement of cash flows. So these are the handful of items, the handful of categories that you will find in the statement of cash flows, the CAMS framework. Let's apply the CAMS framework a little. Let me go into those movements. Before we apply it, I want to pause to take questions and comments. Questions, comments. Questions, comments. Yes, Mr. Chukuka. Mr. Chukuka, it looks like they've tied statement of cash flows to a bonus for you, but it's fine. Keep the questions coming.
No, I've actually had ICANN classes and everything, and I
Okay.
found it very, very well. It's been very, very tough for me to, even to today. I qualified in May, but till today I do not understand statement of cash flows.
Fantastic.
So
Were you
that's why.
around last week?
No, sir. Network was really
Oops.
bad, so I couldn't.
Okay. Maybe at your free time, you can just check up the recording. It will be useful. That one just helps you make more sense of it. Then this one is now in preparation. But anyways, go ahead with your question and comment.
Okay, thank you very much. It's actually about the adjustments.
Okay.
Hmm? Do you find these adjustments? Because it actually appeared to me like most of these adjustments are on the statement of profit and loss or loss, right? Are
Yes.
there adjustments, you find, or items you find for adjustments, in the statement of financial position?
Most likely, the answer is no or yes. The reason I want to say no is that, remember I said that the adjustments arise from items that were used in deriving what? Profit. So that means most of the times you would find them in the profit or loss. In short, all of the time you find them in the profit or loss because you are simply looking for items that were used in deriving profit. I don't know if you get the analogy.
Yes, I get it.
Great.
Okay.
Now, the reason why I now said yes is because there is a link. You can also find them in the statement of financial position because if you debit something to income statement, you might credit it into the balance sheet. So you can also find it in the balance sheet. So a
Okay,
depreciation, for example.
can you name one of them? One of the that we can. Popular one.
Great. A depreciation, for example. Look at this note here. Let me show you. This is the notes for PPE. Please confirm you can see the notes for PPE.
Yeah, clearly.
Great. Now, this is the depreciation charge for the year, 187. And you know PPE is a balance sheet item.
Yeah.
This same 187, I should be able to find it in the notes for administrative expenses for profit or loss. Depreciation 166. It's probably scattered somewhere else. It's probably locking somewhere else. So this one is 66. Yeah, it's probably looking somewhere else. Maybe it has been allocated elsewhere. But what I'm trying to say is that this 187 we have here. Okay, sorry, I was looking at 2023. So this is 156 for 2024. Ordinarily, what you should find here for depreciation should also be 156. Probably an error or typo somewhere. Let's use interest expense. So you have interest expense here of 91,759. If you come to the income statement here, you see the 91,759. Please confirm you can see it in the income statement.
Yes, I can see clearly.
Good. If I go to my borrowings, I will find the same 91,759. Can you see it?
Yeah.
Great. So it means that there is a link between the income statement and the balance sheet. That's what you are looking for as adjustment in profit. You can also find it in the balance sheet, but it is quicker to search for it through the income statement.
Okay.
Yeah.
Yeah, thank you.
All right. Let me see if we have more questions. Mr. Olayemi Stephen.
Thank you. Thank you very much for the presentation so far. So my question is around S in CAMS.
All
So
right.
you had said that they are related to like a balancing item, interest paid, interest received, dividend paid. So you're looking at interest paid and maybe income tax. There are instances where you have interest accrued and tax expenses accrued in the books, and it's
Hmm.
different from the actual payment.
Hmm.
So are you saying that those two will be, because I would expect that the interest accrued maybe to come under the current liability, then you adjust for it. What you now show will be the actual payment that you have
Hmm.
here. So that's actually one of my confusions when it comes to cash flow.
All right. So let's start with the example you give. Interest, that's the interest expense for the year. That's the amount you owe the lender versus the amount you actually paid. Because you may
Yes.
owe the lender 10 million or you may end up paying 8 million. That's why the two of them
Yes.
can be different. Great. The amount you owe the lender, that's the interest expense, you most likely find it under A because that interest expense was used in deriving profit. You get the logic?
Yes.
So you most likely find it under this A as an adjustment. Then the actual interest paid is likely a cash outflow in C as a category. Let me show you how it worked in this statement of cash flows. Like I said at the beginning, this statement of cash flows has already been prepared completely here. We just want to recreate it. So look at the interest expense here under adjustment in the operating activity. And it's under adjustment because it was used in deriving this profit. That's why. At the same time, if you scroll down, you'll find an interest paid here because this is the actual payment that was done.
Oh,
And all these two, you will trace them in to this place because they are part of the breakdown of what made borrowings move. So this is where you trace them to this note 27.3. Well, just to answer your question.
so the interest paid now in this instance
Hmm.
is not coming up under financing activities.
Well, we can choose. Remember last week we said that we can choose to treat it either as operating or financing. Anyone is fine.
Okay. Okay.
Yep.
Clear. So that means in this case,
Hmm.
they didn't balance out in a way.
Yeah,
In
they didn't.
instance, okay, okay. Thank you very much.
Sometimes the same amount here can be the same amount here, but this time it's not.
Yes, yes. So that was actually my confusion. I needed to clarify from what you said earlier. Thank you very
Yeah.
much.
Let me also add that even if they are the same, you must do that in and out because it's a specific disclosure requirement.
Okay.
That's why that S category was created. So even if the interest expense is 91,759 and the interest paid is 91,759, you must do this in and out, just so you show it clearly on the face of the statement of financial position, the interest paid.
So please, if I can now ask an extended question.
Sure.
So does that means that when I'm preparing my account, my GL, I must ensure that transactions are posted in a way that I can easily separate tax accrual, tax payment, interest accrual, interest paid. You just see instances where everything is lumped together in one
You
big
are very
account.
correct. You are very correct. Now you are beginning to see the reason why we started with that mantra, where we said that, repeat after me. My statement of cash flows is as accurate as how well I can drill down. So when people are lumping up, the statement of cash flows will be very difficult to prepare.
Yeah.
All
Thank you.
right. Yeah. Let me take one more question and we will proceed to step 4. Mr. Godson appears first here. Mr. Umar Farouk, probably maybe after step 4, I'll definitely call on you. Let me start with Mr. Godson. Your hand is up, Mr. Godson, and you have the mic.
Okay, good evening.
Yes, sir.
I have 2 questions, please. So the first question, I know we're talking about the bank accounts. So the second category that has to do with A. What of if there was a cost that was paid last year and the cost is being amortized over a period of 12 months? And so this year, so some of the expenses, amortized expenses, fell into this year, and I'm trying to prepare a cash flow. Should I bring it? Should I adjust the expenses as a non-cash item?
Exactly. You are beginning to get it now. Exactly. To be under A, you are correct.
Okay.
Yeah.
So my second question, I work in a company where we have high value of contract liabilities. So so what we do, we sell and market gas, natural gas, to some of our customers due to lack of funds from our side. So we give allowance for our customers to build the gas facilities. And so when they build it, then they start recovering the cost through gas sales. So now, when you come to the balance sheet, you see that you have 2 portions of this contract liability. One will fall into current and non-current. But you not see that some of the so can you hear me?
Yeah, I'm following you closely.
Okay, so now, you now see that some of the liabilities will not be recovered through gas sales. So my challenge is, so I don't know whether you can help me attend to it.
Okay, so I'm trying to understand you. Company A, that's your
I don't know whether
company.
you got my question.
Yes, I'm trying to paraphrase your question. So company A,
Yes.
you sell gas. Now, you sold gas to some of your customers, but you don't collect money from them instantly, right? Hello? Yes.
Yes.
So you want the customers to have their own facilities before you start collecting monies from them? Hello?
Hello?
Hello? Can you hear me?
So what happens here? Hello? Hello?
Yeah, please, go
Yeah, I can hear
ahead.
you. Hello?
Please go ahead. Go ahead.
So what happens is that we sell pipeline natural gas, that's PNG, to some customers, that's some companies. I know the high cost of establishing delivery facilities from our company to the customers. They use their money to build all these gas delivery facilities that collect the gas from our own pipeline to their own factories. So many times they now recover this cost through monthly gas sales.
Okay.
So now my challenge is that I always have issues accounting for this on the cash flow because of current portion on the balance sheet. So this has
Your network keeps interfering, but I want
my challenge.
you know what? Because this is an interesting question, and it's a space I probably have played in the past, and your network is fluctuating. Can we hold on to it? I'll just note it down till after the session. Hopefully by then your network will be better, and we can, spend more time on hello, hello, can you hear me? I think that's the way we should manage it. I've written your name down, Mr. Godson. All right, let's go ahead. I still have quite a lot to cover. So the step 3 says that classify each into the camps. So step 3, let's go and apply the camps extensively now. What I just did was just picking it one by one to explain. Let's apply it extensively now. So let's come back to the SFP. Remember what we did from step 1, where we got this movement in opening and closing balances. Step 2 says that, they are in the notes, the breakdown of this movement. Now, step 3 is now saying that when you now find each of those breakdown, classify them into the camps. Let's start with 268,387. Please follow me closely. We're about to move into more sensitive aspects. So let's look for this 268,387. Where is it in the notes? I come to note 17. You might not always find that figure as one figure in the notes. You might find it broken down into various lines, but when you add up those lines, they should give you that total. So we start with cost. So what made the cost move from last year to this year? Remember that PPE has cost and accumulated depreciation. So first we start with cost. So the movement in the cost started with an addition. An addition means that we purchased PPE or we acquired PPE during the year to the tune of 456 million. Ladies and gentlemen, of the camps, an acquisition of property, plant, and equipment will fall under which of the camps? Let me project the camps again. An acquisition, you spent money to purchase or to acquire property, plant, and equipment. Is it a C? Is it A? Is it M? Is it P? Or is it S? So let's see what they are saying. Everybody is saying C, 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 C. Yes, I agree with you. It's actually a cash outflow, so it falls into C. So what step 4 now says is that, okay, you have determined it to be a cash outflow. Some of it may not be an outflow. In practice, you might actually find out that some of them you have not paid for it yet. You only restrict the cash outflow to the portion you have paid. Let's just assume that we have paid for everything, 456. When I come to my statement of cash flows, there are 3 compartments. There's the operating, there's the investing, and there's the financing. So my question to you, which of these 3 compartments will that cash outflow fall into? Is it investing? Is it operating? Or is it financing? Remember how we started last week to give us a sense of what each of these activities mean. So when I'm spending money on a property, plant, and equipment, is it in? Okay, thank you very much for the responses. It's clearly investing because we are acquiring a long-term asset. So you come under this investing, you type in acquisition of property, plant, and equipment. It's in note 17, so I will just make reference to that note. And I will say equal to minus. I put minus in front because it's an outflow so that it will come out as negative. I will link it to note 17, this 456 here. And 456 is in. So little by little, we are bringing in that 268 million into the statement of cash flows, small, small. I come back to note 17. I have treated this 456. The next thing, there was a revaluation surplus. What is a revaluation surplus? A revaluation surplus means that there are some class of assets that at certain time in the year, you would call a valuer to revalue them. There are valuers all over the country. We have Jide Taiwo, Dia Fatime, Ubo, Elesi and Co. So many valuers, they take your asset and they help you value it, your property. So you may get one of those valuers to value that property, and once they value it, whatever value they get may be higher than what you have in your records. Once the value they derive is higher than what you have in your records, you will most likely have what they call revaluation surplus. Now, having that understanding, let me go back to the camps. This 21.6 million for revaluation surplus is just saying that the value of my asset has increased by 21.6 million. Where will it fall into? Is it a C? Is it A or an A rather? Is it M? Is it P or is it S? Where will it fall into? Where will it? Somebody said operating. Remember, you must first classify it into a camps before you now classify it into operating, investing, or financing. So camps come first. Everybody chose adjustment. Unfortunately, the road to beans is very wide. The answer is not A. It's a non-cash item, pretty much you are correct, but it was not used in deriving profit. Therefore, it will not fall into A. It doesn't fall into any of the camps. Remember, for something to fall into A, it must be used in deriving profit. It is not even an S. It is not interest paid or received. It's not dividend paid or received. It's not income tax paid. So it doesn't fall into any of these camps. To refresh your memory, let's go back to this income statement. Look at this income statement. Look at the profit, A185. Look at that 21 million you are talking about. So you say that the 21 million was used after, not before. Therefore, it is not a member of camps. It is under other comprehensive income. And once it is not a member of camps, it will not show up in the statement of cash flows. So what I'm telling you that if you find something that is not a member of camps in a statement of cash flows, you should question the accuracy of that statement of cash flows. So revaluation surplus is not a cash inflow or outflow. It is not an adjustment used to derive profit. It is not a movement in working capital. It is not profit or loss. It is not specific disclosure requirement stuff. Therefore, it cannot appear on the statement of cash flows. So everybody that said A, thank you for your attempt, but you were not correct. You were correct to the extent that it was non-cash, but you forgot that it was used after deriving profit, not before deriving profit. I hope we are clear on that. Please give me a thumbs up if we are clear on that. Even if you told me A, I forgive you. Give me a thumbs up if we are clear on that. Don't forget, anything that comes under A must have been used in deriving profit. That is the learning here for you. Thank you, Mr. Ibrahim Yusuf. The reclassification had nil impact, so we will not dwell on this. The total impact was 0. Then we have a disposal of 87 million. When you are dealing with a disposal, two things are mostly involved. You sold an asset, and after selling it, you gave somebody the asset, and after giving the person the asset, the person probably gave you what? Cash. In accounting, once you dispose an asset, the initial cost you spent on the asset will be removed from your records. So that what you have here as 87 is not the real cash you collected from the person. Take note. I intentionally included all these tricky parts in what we are doing so that you can have a sense of a complex scenario. So anytime you see a disposal in your PPE, do not hurriedly take this 87 as the money you collected to sell it. No. This 87 here that is under the cost or any amount that you find here as a deduction from the cost is simply saying that I no longer own this asset. The cost I incurred on it historically, I want to remove it from my books. What we technically call derecognize. So this is me removing the historical cost. It has nothing to do yet with the cash proceeds. If I want to know the cash proceeds I got for the sale of this asset, I should check my bank statement, or I should check my cash account, or I should speak with the Treasury Department, or I should check my GL. I should check something that will show me the amount that was eventually received. So this is not the amount. 87 was not what we received. I will need to look for the appropriate note. Typically, when you have a disposal, in your income statement, you have a gain or loss on disposal. So just go to that note on gain or loss on disposal. Let me look for that note. Gain or loss. Okay, here it is, 2.8. Well, they didn't give us the proceeds. The proceeds is somewhere here. There's a schedule here, but I want to save time. I will just check what we have already completely prepared. So the proceeds from the accounting records is 55.213 million. So the proceeds is not something you always have to calculate. Sometimes you might have to calculate it, but in practice, it's pretty straightforward. Just go and ask the people who sold the asset, how much did you collect for it? It's that simple. And if you can't go through that hassle, there's also a way to calculate it, but for the sake of time, we can just push that after the session. So the amount that we got from selling the asset will be an inflow. We'll call it proceeds from disposal of PPE. And that is 55,213 obtained from the accounting records. So when you have a disposal as well, it doesn't stop there. I told you that there are two things that are involved with disposal. You collected money. That's the first thing. That is what you have put here. The second thing is that you gave out your asset. You disposed the asset. Because of that, there's what they call a gain or a loss on disposal. That means you sold the asset for 55 million, for example, but the value to you, maybe the value to you is 58 million, for example. So if the value in your records is 58 million, but you sold it for 55 million, that means you have lost on that transaction because you have sold it less than its value in your records. IAS 16, the relevant accounting standard, will now tell you to book what they call a gain or a loss on disposal. So anytime you see a disposal in any PPE schedule, always search for the gain or loss on disposal. It is the second part of dealing with a disposal inside your statement of cash flows. So gain or loss on disposal. So we have a 2873 gain on disposal. So I ask you again, this 2873, which of the camps can we classify it to? This 2873. Of course, this 55 million, I didn't bother it because this one is clearly a cash inflow. So it is a C and it involves selling PPE. So that's pretty straightforward. So the second part of a disposal, each and every time, is the gain or loss on disposal. In this case, it's a gain on disposal. So this 2873, which of the camps will you throw it into? Is it C? Is it A? Is it M? Is it P? Or is it S? C is cash inflow or outflow. A, you must check Was that item used in deriving profit on loss or loss rather? M, is it a movement in working capital? Movement in working capital is simply what you find in current asset and current liability. It's as simple as that. P, is it profit or loss? Profit or loss is what we obtain from the income statement. That one, we've already brought it in. Or is it S? Some people said A in the chat box. Some people said it is not in camps, but I'm sorry to burst your bubble. This 2873 is a bona fide member of the A category because it was used in deriving the profit for the year. Look at the profit for the year. Look at the 2873. So you see that is a member of the camps. It's actually an A. It is an adjustment for an item that was used in deriving profit, but that item is not actual cash. I hope that is clear. To the people who picked anything other than A, it's actually an A because it is a non-cash item used before deriving this profit. So under the statement of cash flows, it will come under adjustments. Here, as a gain on disposal of PPE. It was previously added as if it's an inflow, whereas it is not an inflow. The real inflow has been booked down here. So this gain is not an inflow. They adding it as if it's an inflow. Cash flow will reject it and will tell you, deduct it. So we have to deduct that 2873. Just continue following me. PPE is probably the most complex part to bring into the statement of cash flows. Just follow me little by little. That is the gain on disposal. Let me come back to the note 17. Remember what we are trying to do. Every item that make up the movement in the cost, every item that make up the movement in the accumulated depreciation, we must associate them with the camps. Once we associate them with the camps, we must associate them with either operating, investing, or financing. Remember the concept. For them to appear on the statement of cash flows, they must fall into either C, A, M, P, or S. That's the bucket they must fall into. If they don't fall into that bucket and they fall out, they cannot make it into the statement of cash flows. So we have assessed this addition. It was an investing cash flow. We have assessed this surplus. It fell outside of the bucket. And we have also assessed this disposal. Remember what we said about disposal? Two things. You collected money and you gave up your asset. The sales proceeds from the collection will appear under investing. Because you gave up your assets, the standard will tell you to recognize whether a gain or a loss on disposal. A gain or a loss on disposal is a typical member of A because it was used in deriving profit and it is not a cash item. You can pretty much just paint all of this and say green. I'm done with evaluating all the movement in the cost of PPE. The next thing is to evaluate the movement in the accumulated depreciation. And before I do that, I will pause to take questions. Or let me just go ahead. Let me go ahead. So we'll finish the PPE once and for all. Let me go ahead. So under accumulated depreciation in 2024, the things that caused it to move are the charge for the year, that's the depreciation charge for the year, and the disposal. We have dealt with the disposal previously, so we no longer need to disturb ourselves about this 34 million. So for the charge for the year, 156. This is the depreciation that was charged during the year. I want to ask again, this depreciation charged during the year, what is the appropriate bucket that we can throw it into? Is it a C? Let me project this again. Is depreciation a cash outflow or inflow? Is it an A, an adjustment for no cash item that was used in deriving profit? Is it a movement in working capital? Remember, movement in working capital is current assets and current liability items. Sefini. Is it a profit or loss item? And is it an S? Let's see what they are saying in the chat box. Everybody said A. You are all correct. I wanted to play Who Wants to Be a Millionaire. So you are all correct. It's an adjustment for non-cash item that was used in deriving profit. So it's an A. How did I establish that? How did I confirm that you are correct? When I come to my income statement, this is my profit. When I drill down into each of these line items, I will find depreciation under administrative expenses. And administrative expenses was used in deriving profit. And I know that depreciation does not involve movement of cash. Therefore, it will typically appear here, depreciation. It was previously deducted. What that means is that I now have to add it back, depreciation on PPE. I need to add it back. So I can pick it from note 17, 156,942. Can link this to 70. Can also link this gain on disposal to the note as appropriate. That's note 15. Ladies and gentlemen, what I've done now is that I'm through with evaluating the movement, each and every line item that caused the movement in my PPE. I'm through with all of them. I'm fine with the PPE. So all the items that caused the movement in my PPE, you can see them, I painted them green. I analyzed them one by one into the camps. And as I was analyzing them into the camps, I was categorizing them into the correct activity as operating, investing, or financing. Let me now pause for question. You'll find out that the remaining ones will now be very straightforward. PP is usually the most difficult line item to bring in. The remaining ones will just be easier. So let me pause and hear your questions. I think I'll take Mr. Umar's question first. He had his hand up earlier and I didn't call on him.
Good evening, sir.
Yes, sir. Good evening.
I just wanted you to explain more on the first line item, which is the profit for the year that you use instead of profit before tax.
Okay. So what I said here, you know why I use this profit for the year? When we get to retained earnings, you will see why. Let me just leave it there. So when we get to retained earnings, you'll see why I used it. But if you also use profit before tax, you are fine. The reason why, let me just tell you why. The reason why I use this profit for the year is because when I come to this SFP and I come to this movement in retained earnings of 175, when I break down this 175 by going to this note 25, for example, look at the two items that are inside this 175. Can you see it?
Yes, sir.
So it's easier for me to just bring in the profit for the year 185 and bring in the dividend if it is paid 10 million. It's easier that way than bringing pre-profit before tax. It's clearer to me. That's why I always start with profit for the year, because I can easily trace that profit for the year as something that made retained earnings to move from its opening balance to the closing balance. That's why I prefer profit for the year.
Okay, so let's try to juxtapose this now with IFRS 18.
Okay.
Does this lie with IFRS 18?
Yes. IFRS 18 mostly focuses on the income statement. So IFRS 18 doesn't dabble too much into statement of cash flows. Remember that statement of cash flows is the terrain of IAS 7.
Yes.
Yeah. So it's fine
Okay.
under IFRS 18, yes.
Thank you.
All right, sir. Mr. Johnson Edward. Then I'll take some questions from the chat box. I've been leaving them out since.
Very good evening, sir.
Good evening, Mr. Johnson.
So my question is on acquisition of fixed assets. So I
Okay.
observed you pick the figure directly from the
Okay.
PPE schedule. So I was considering how, if it is really safe to do so, being that that total amount may incorporate some
Accrual.
accrued, thank you,
Yeah.
accrued amounts. So, for
So,
instance, in instances of assets, payments, advance payment for fixed assets in a previous year, whereas
mm,
the asset was delivered in the current year.
yes, you are correct. So that's why I don't know if you joined when I said that once you start picking the items from your note to the statement of cash flows, it begins to show you the things that you need to bring to your notes. Now, when I was explaining this 456, I said you may also need to check if this 456 you entirely paid for them in that year. If you did not entirely pay for this 456 in that year, you will need to create another note under this PPE, maybe in note 17.1, that you can now call cash, PPE cash acquisition during the year. Then you then analyze it. Then you say acquisition per schedule. Don't mind that spelling. That's just let's just assume that it's schedule I wanted to spell there. So you link it to this 456. You know that 456 is not entirely cash. Then you now say, okay, less, like you mentioned, the example you give, advance paid in
In
previous
previous year.
years,
Thank you.
now recognized in current year. So maybe
Okay.
that one is 54, blah, blah, blah. Just an example like this. Then that means the actual cash during the year was 401. So by the time you are bringing it to your statement of cash flows, you will now say equal to minus. You will link it to this 401.
Oh,
And this note
okay.
will not be 17 again. You will now link it to note 17.1,
One. Okay.
like this. This is how it would have looked. So this is a clear example of a case where statement of cash flow is telling you that your note needs to tell me more. Go and adjust your note. And that's why we did this, which is allowed.
Okay. Thank you very much. Your answer is very clear.
All right, sir.
So I have another question, but I
Sure,
don't
please
know
go
if
ahead.
it will be too early to ask.
Okay.
It's concerning overdrafts, bank
Okay.
overdraft. So I think let me just allow you to conclude first.
Okay. No problem.
Thank you.
All right. Let me take question from the chat box. Exclusive said, why is the gain on disposal recognized as other income in the income statement instead of the sales proceeds? Remember, in accounting, IS 16 rather, when you sell an asset, or generally, let's start with generally, IFRS is based on accrual accounting. That's the number one thing. So it is not what you collect as cash that is your actual income. Remember that asset you are selling, you also spent money on it in the past. So your actual income is whatever value that asset is in your hands right now, minus what you received for it. That's your income. Because in the first place, they didn't dash you the asset. You also use your money to buy the asset. So because you use your money to buy the asset, that cost will be considered in getting your net income from selling the asset. Let me see if I can unmute exclusive to see whether he or she understands my point. Exclusive, I don't know if you are where you can speak.
All right, thank you. It's well understood.
Okay. So to add to it now, if, for example, you go out to go and buy something 10 naira and you have spent the 10 naira, you now want to sell that thing again. You now sold it to somebody for 15 naira. Your income is 5 naira because you have incurred the cost before you went ahead to sell it. So that's why that sales proceeds is not really the income. Okay, for the sake of time, we have less than 45 minutes to go. Let's see where we can land. I just want you to understand this principle, which I think most of us are already getting. The next line item is right of use asset. So again, this is your right of use asset, 6.6 million. I want to know the breakdown of this 6.6 million. Remember where you can get the breakdown? In your notes. In your notes. If your notes cannot provide you with insight to this breakdown, it means that your notes is not yet sufficient. Look at what we just did now when we asked a question just now. So your notes should be explicit enough to show you where this breakdown is. This 6.6 now, let's go to note 18. So this is note 18. Like PPE, right of use asset is broken down into the cost element and the accumulated amortization element. So if we start with the cost element, in 2024, there was no addition. There was no movement in the cost in 2024. It was 143.46 last year. It is still 143.46 this year. Then what is costing that 6.6 million? It must be in the accumulated amortization. Look at it here. Accumulated amortization was 39.3 million, 39.3 million. And it's ending with 45.9 million. It means that something changed. And the thing that changed was that we had an additional charge during the year, an additional amortization of right of use assets. Right of use assets are assets, they are leased assets. So the amount you paid for that leased asset, you have to amortize it over the lease term or the useful life, whichever is shorter. So this 6.6 is like the annual amortization to the income statement. So this 6.6, the next question I ask you, which category can we throw it? Let me show us our camps again. An amortization of right of use assets, is this a cash outflow? Is it an adjustment for non-cash item that was used in deriving profit? Is it a movement in working capital? Is it profit or loss? Is it a specific disclosure requirement? What do you think it is? Thank you very much. It's clearly an A because it was used in deriving profit. How do we know that it was used in deriving profit? Remember the logic. You come to your income statement. Any item that was used in all these places I highlighted, they must have gone into getting this profit for the year. It is those items that will fall under A as long as they are non-cash items. The amortization was booked as part of administrative expenses. So if I come to my statement of cash flows, under adjustments, I will have a line called amortization of right of use assets. That is note 18, I think. Note 18. You can see how the notes are revealing everything. That is how your FS should be, linked, clear. There's nothing hidden. Remember what I said again, I repeat it again. Once you are drilling down into any of those differences and your note is not able to explain it, something is wrong with the note. Something is insufficient with the notes. You need to add more information. That's one important rule, which we practicalized some minutes ago when that brilliant question was asked. So for the right of use assets, which is a positive 6.6 million, if I come here, it's the same positive 6.6 million that threw up here. It's fine. It's already into the statement of cash flow because it was part of the camps. Straightforward. The next one is this 3302. Again, this 3302, Where can we find it? Oh, the balance sheet says we can go to note 19 and see the story around it. If I go to note 19 and I can't find something that breaks this 3302 down, then my note is not sufficient. That is the law or the principle. Don't let me call it a law. So let me go to note 19. So it's either it gives you a breakdown or it gives you the figure itself as a lump sum. So let's go to note 19. Note 19 is for intangible assets. As with right of use assets and property, plant, and equipment, intangible assets are also broken down into cost and accumulated amortization. So we'll start with the cost. You see, in 2024, the cost remained the same. So it's likely that it's not this cost that is making this balance move. The thing that is making this balance move must be here in accumulated amortization. And we can see it here. There was an additional amortization charged during the year of 3.3 million. That is the reason why the balance changed between last year and this year. All right. The note has explained it. The next question, as usual, which of the camps will it fall into? Is it a C? Is it an A? Is it an M? Remember, M is current asset and current liability. You can't, if it is not part of current asset and current liability, don't call M. Is it a P, profit or loss? Is it S? And the specific disclosure requirement, look at them. I've listed them specifically here. These are the cash flows that you must disclose specifically on the face of your statement of cash flows. So let's see if the chat box contains the right answer. Thank you very much. The answer is A. Why? Because it was used in deriving profit. And how will you know if it's used in deriving profit? I take it again. It must be part of the items that form any of these areas that I've highlighted that came before profit for the year. It is not part of items that come after. Take note, just like the mistake we made when we were analyzing this evaluation. So you must be able to trace it to something that came before profit for the year. And that thing must be non-cash in nature. And amortization of intangible assets is typically non-cash in nature. So, intangible assets. Link it to note 19. I pick the 3.3 million from note 19. No hard-coded figure. Everything is clearly linked. Why? Because the note contains sufficient information to explain things. That's why the linking is happening. In short, if not all your items, if not all self must be linked to something in the notes in your statement of cash flows. If not all, most of them should be. Otherwise, you have conjured something. By conjure, you have planted something to force the cash flow to balance, which is not our style. So if I come to the SFP, this 3.3 is now in the statement of cash flows. Welcome. The next one is inventory, trade and other receivables, advance to suppliers. Let's start with inventory. This movement that we have here between last year and this year, which category does it fall into? Because if I go to note 20, note 20 will not break down this 273 for me. That's the thing with working capital items. Most of the time, you may not find the breakdown. So when you are dealing with them, so let me just ask blanket, which of the camps will inventory, trade and other receivables, advance to suppliers, which of the camps will they fall into? M, exactly. As I said that they are the easiest. You don't even need to go to note self sometimes. So inventory, trade and other receivables, advance to suppliers and prepayment. Let me come down. Anything under current liability as well, except this borrowings and this current tax liability, because they are special. They have their own special cash flows based on S. So these two don't include them in your movement in working capital. So we'll bring in this trade and other payable and contract liabilities, and we'll bring in this inventory and trade and other receivables and advance to suppliers. So they are pure M items. Now, you have agreed that they are M items. The next question is, are they operating, are they investing, or are they financing? What do you all think? Are they operating, are they investing, or are they financing? Exactly. A movement in capital, a working capital is typically under operating activity. So we have changes in inventory, changes in trade and other receivables. In short, some people don't even put the changes. Some people just say movement in working capital for, I think that's the style I would just adopt to make it easier, quicker rather, for inventory, trade and other receivables. After trade and other receivables, let me see. Advance to suppliers. You don't bring in cash and cash equivalent because it is the reason for this. It's the reason why you're preparing this. So you don't need to bring in the movement in cash and cash equivalent. So if a contract liability has a non-current portion, you most likely still, analyze it as part of this movement in working capital. Or if, you know what, let me deal with that after. Because it might also have a corresponding leg in trade and other receivables. So let me just deal with that after. So advance to suppliers, then under current liabilities, trade and other payables and contract liabilities, I copy all of this and I paste it here. So straightforward. For inventory, because it is an asset, it will be prior year minus current year. Prior year minus current year. It's positive, telling you that you sold some of your inventory, therefore cash has flowed in. It's a positive financial position. I can just drag this down for trade and other receivables and the advance. Then for trade and other payable, which is liability, it is current year minus prior year. Current year minus prior year for the liabilities. I can drag it down as well. And voila. What does that mean? It means that this 6625 and this 104, they have been brought in. I can paint it green. When I go up, this inventory and this up to the advance, they've also been brought in green. See? As I said, they are the easiest to bring into the statement of cash flows. Just prior year minus current year minus prior year, and they have jumped, they're already appearing in your statement of cash flows. The next line is cash and cash equivalent. You can ignore that. So we are done with dealing with all our assets. We can then look into dealing with equity and liabilities. So let me pause and hear from you. Just what we have been doing so far is very simple. After getting those differences, drilling down, are they part of the camps? Yes. If they are part of the camps, which activity or operating, throw it under operating. If they are not part of the camps, they won't go into the statement of cash flows. So let's hear from you guys listening to me. I think Mr. Emmanuel has his hand up. Mr. Emmanuel, you have the mic.
Yeah, good evening.
Good evening.
Okay, so please, could you explain again why for assets we do prior year minus current year, and for liabilities we do current year minus prior year?
Okay, so for assets, the way to know whether they they have led to an outflow of cash, so to say, is by comparing what they had last year, right, and what it has this year. That's the balance this year. So if, for example, what you have last year in terms of the assets you were holding was 1.4 billion, and what you have this year is 1.6 billion, it means that you have bought more assets. That's what this means. If you went to go and do current year minus prior year, you may not get that interpretation correctly. So if, for example, I did this minus this, this is simply telling me that, oh, I sold asset, therefore cash has come in, whereas this is wrong. So for us to really get that analogy correctly, it must be prior year minus current year, because the idea is that I'm comparing the asset I had in my hand at the beginning of the year with the asset I had in my hand at the end of the year, so that I can identify the ones that I've sold off or the ones that I've bought more of. I don't know if you get my point. Hi, Mr. Emmanuel has muted. Mr. Emmanuel, you have the mic.
Yes, I understand that. Thank you.
All right. Olaide Ifeoluwa.
Okay, good evening.
Good evening, ma.
Apologies for drawing you back. Somebody asked a question, and when we went back to the other time too, I too felt I should ask the question because I don't think you
Okay.
answered the question because
Okay.
I saw that in ICANN class, theoretical class, question, theory classes under cash flow, they start with profit before tax, and you are using profit for the year. Can you tell me the behind it? And
Good. So please don't mute. Remember that the whole idea for us is to break down each of these differences, but you understand that principle?
Yes.
Good. When I come to retained earnings, this is the movement in retained earnings 175,202. I need a clear breakdown of this 175,202. I will go to note 25. And when I come here, the breakdown of that 175,202 is this profit of 185 and this dividend declare of 10. So it makes things clearer for me if I bring this profit 185 the way it is like this to the statement of cash flows than bringing profit before tax. Because I can see it clearly in my head that, oh, this 185 here is just simply helping me to explain this 175.
Okay.
So it's because of that clarity. At the end of the day, the man who used PBT and me who used profit for the year will still arrive at the same thing. Me, I just prefer that profit for the year because of that clarity. So if I'm trying to trace how I break down each of them one by one, it is easier for me.
Okay.
Yes.
Thank you.
Yeah.
All right. Thank you.
Yep. So somebody said, take into consideration the consistency principle. Is there any effect of starting? Well, there's no effect, but like I've said, take into consideration consistency principle. It will be good for you to start with the same line every year. That's just the thing. It will be good to start with the same line every year. Madam Bint, I'm here to get my scores for the FS preparation assignment submitted. Don't worry, I'll look through it. I have quite a number of submissions, so I'm just looking at them little by little and dropping comments on each, because I'm taking my time to really go through those documents. Sorry for the delay. Because we just have like 10 minutes more. Let me go ahead. So the next item I want to bring into the statement of cash flows is the share capital. Share capital. So the share capital is, it was 5 million last year, and now it's 10 million this year. So when my capital is increasing, it means that I've issued more capital out there, and I've probably collected some consideration in return. So what that means is that inside this 5 million, I need to find out whether the people whom I gave shares to, they finished paying up for the shares. I need to find out. How much did they pay for the shares? That's what I need to find out with this 5 million. So that once I find out, I can now treat it as any member of the camps appropriately and put it under the right activity. So I want to push this question to you listening to me. How do you think I can find out how much they've paid during the year, whether these shareholders have paid for these shares that they took during the year? How do you think I can find out? Practically speaking, how do you think I can get that information? Somebody said from note 24. Mr. Ibrahim Yusuf said notes. Release it. Some people said bank, some people said statement of changes in equity. Some still said, the person who said bank, I agree with you completely. That is the best bet. Or your cash account. How much have we collected? That one cannot lie. Like they always say, cash is reality. Your statement of changes in equity may not show it. Statement of changes in equity will only show the shares you issued out. It will not tell you the story of the money you collected. So your bank or your cash ledger should tell the story. But the people who said notes, I also agree with you. So if, for example, now I come to this note 24, and the note 24 is not telling me the story, it means that this note 24 is not sufficient enough yet for me. I need to state it inside this note, the amount that has been received as cash and the amount that has not been received as cash. Therefore, it will lead me to updating this note. And go as far as saying during the year, 5 million worth of shares was issued. X Naira was received for the shares during the year. The balance is yet to be paid. Sometimes there's this disclosure around issued and fully paid up, issued and not fully paid up. Sometimes those disclosures can also be important here. But this simple writing here can solve that problem for me. So it's now time for me to go to my bank account to go and find out how much they actually paid. Check with the shareholder self to find out, do that proper reconciliation. But all these things would have been cleared out because you are preparing this based on an audited trial balance. So this is one way I will go about it that is quick without stressing myself. I will go to the other receivables to see if there's any receivable due from shareholders. Look at this line. So if there's any receivable due from shareholders, it means that the shareholders have not paid for the shares to the tune of this amount. They still owe us this amount while they've paid for the remaining. So if they took up shares of 5 million and the balance left is 1525, how much did they pay? So if they took up shares of 5 million and the amount that they've not paid for yet is 1525, how much do you think they paid? Or how much did they pay for? 3475. Thank you very much, Mr. Ibrahim and Owen. So it was 3475. That is the 5 million minus this 1525. You bought something of 5 million, but the balance you are yet to pay is 1525. It means that you must have paid the remaining 3475. So what will appear in that note, I'll first go and update that note to say issued. Instead of writing story like this, another way I can do it is this, to say amount paid for shares during the year. And be as simple as that. 3475. Last year, if I paid something, I can also put it there. And this is what I'll now, show. Come to my statement of cash flows. Now, before I come to the statement of cash flows, now that I've gotten the amount I paid for shares, which of the camps will I dump it into? C, A, M, P, or S? So this 3475 received from the shareholders, where will I put it? Is it a C? Is it an A? Is it an M? Is it a P? Is it an S? Mr. Emmanuel says it's a C. Mr. Jesus says a C. Madam Freke said C. Madam Rachel said C. Mr. Ibrahim said S. I don't think it's an S because you know what the S's are. They are very clear. So it's most likely a C, a cash inflow, because we can't find issue of shares here in this specific disclosure requirement. So it's most likely a C. So we'll bring it to the statement of cash flows. Now, which other activity will we dump it? Operating, investing, or financing? Operating, investing, or financing? Yes, it's financing because we can raise finance through debt or through equity. We chose equity this time. So we'll say issue of equity shares. So that is 3475. So instead of typing it, I will link to that note. This is it. Note 24. Note 24. So 3475 has appeared here. But if you look at your SFP, what we need to appear is 5 million. That's what must appear. But only 3475 has appeared. So there is still a 15 something that is unaccounted for. Where do you think that 15 something is? So let me explain again. What we're trying to bring into the statement of cash flow is this share capital. The difference that the balance sheet is throwing up is 5 million. Positive 5 million. Out of this positive 5 million, we have brought in positive 3475. So what it means is that what we are yet to bring in is this 5 million minus this 3475, 1525. How do you think we can bring it in? Thank you, Mr. Emmanuel and Mr. John. So that 1525 is locking inside this trade and other receivables, this movement here. That's where it's locking here. So what it's telling us is that it is appearing as a negative figure as part of these items here. It's part of these negative figures. So to take it out, to cancel out that negative figure, we have to say plus the 1575. I hope this one will not fly over your head, the 1525 rather. So by so doing, we have added 1525 here. We have added 3475 here. If we bring those two together, we would have added 5 million to the statement of cash flows, split into the portion that is in other receivables and the portion that has been collected in cash. Somehow, the 5 million is represented on the face of the statement of cash flows. All right, let's continue. I know some people might still have questions on that. Now, 5 million is in, broken down into the portion in other receivables and the portion in financing activities. So this is green. Now to the retained earnings. 175,202. As usual again, we go to the notes. Some persons like me, they may not prepare a note for retained earnings. They may not prepare a note for revaluation surplus. They are not wrong. The reason is that they believe that it's a duplication of effort, because that's what you are looking for in the note can also be found under the statement of changes in equity. You can see the statement of change in equity reconciles the opening balance to the closing balance for each component of equity, which is the same thing a note would have done. So that's why you find in some financial statement, they will not include a note for retained earnings and revaluation surplus because they believe that the statement of change in equity has already taken care of what the note would have done. So no need for duplicating effort. So if you find such financial statement, it is not wrong. But for the sake of simplicity and teaching, I have included a note for retained earnings and revaluation surplus, which is something that some people also do. It's not abnormal. Both are acceptable practices we see out there. So for the retained earnings of 175,202, I need to go to note 25 to find out the breakdown. So going to note 25 shows me that there was a profit or loss for the year. Profit for the year of 185,691, and there was dividend declared. Take note, not dividend paid. Dividend what? Declared of 10,489. So starting with the profit or loss for the year of 185,691, which of the camps should we categorize that profit to? So this profit of 185,691, which of the camps do we throw it into? Thank you very much. He stands on his own. Nobody is touching him. It is P, the profit or loss. P, that is the camps it will go into. He stands on his own, unique profit or loss. And if you come to the statement of cash flows, you will see that we already brought him in up here. Look at him here, profit for the year. So that's why I said that I prefer bringing in profit for the year because it's easier for me to link it into the breakdown in the movement in the retained earnings rather than using profit before tax. That's why I prefer profit for the year. Then the next line that cause retained earnings to move or change is dividend declared. You then need to take a step of faith to find out, have we paid for this dividend? Have we paid 100%? Have we paid the portion? How do you find out? Go to your bank statement. Speak to your legal department. Speak to your treasury. Have you guys paid the dividend? Based on that, you can then even come to now state somewhere down there to state that the dividend paid during the year was so, so that your note will now be sufficient. So let's find out if this dividend declared has been paid in full. Let me see if I can get a clue somewhere. If, for example, in the liability, there's dividend payable, then I know that it has not been paid. So if I come to my liability and I find a dividend payable, so there's nothing like dividend payable. So there's nothing like dividend payable. If I found a dividend payable, it means that that dividend has not been paid. Therefore, I will not bring it as a cash outflow. So since we have established that there is no dividend payable and I've spoken with our Treasury Department, I've spoken with the necessary department and I've found out that the dividend has been paid rather. So ladies and gentlemen, how will we classify the dividend payable? So I can now come here and call it dividend declared and paid. Dividend declared and paid. But if there's a portion there that has not been paid, I will just come down here to put a subtle disclosure to say dividend paid during the year, so that I'll be able to take it to my statement of cash flows. So dividend declared and paid. Where do we put it? Is it a C? Is it an A? Is it an M? Is it a B? Or is it an S? I'm seeing C, I'm seeing S. Both the people that said C and S, you are actually correct. Sound like the church name now. You are correct because it's a cash outflow, and at the same time, it's one of the cash outflows that must be specifically disclosed. So if you say C, you are correct. If you say S, you are also correct. Since we have pocketed it as part of C or S, the question then is, Which of the activities should it go to? Operating, investing, or financing? Which of the activities should we throw it into? Operating, investing, or financing? Everybody said F. Madam Joy Adeyemi said fun. I guess she means fin. Yeah, she's corrected it, fin. F, yes, it's financing. But remember what I said last week. Dividend paid can also be presented under operating. So it's either operating or financing. Anyone you pick as a company, remain consistent with it. Thank you, Madam Pinter. Remain consistent with it. So let's pick financing. So under the statement of cash flows, we go down to financing. Say dividend paid. The notes, that's note 25. Since it's an outflow, it will appear in jacket. That way, we have brought in the profit and we have brought in the dividend. What it means is that we have explained why there was a movement in this 175,202. I mean, the nature of the movement in this 175,202. So I can paint it green. For revaluation surplus, the truth is that I would suggest that we don't even disturb ourselves about it, because we have learned that revaluation surplus is an item also outside of camps, except if there is any item or revaluation surplus that was used in deriving profit. Sometimes you could find such, but if you don't have such, it has no business in your statement of cash flows. And we have learned that the revaluation surplus did not pass through the profit or loss. Therefore, there's no need for us to stress ourselves. We can go straight to the borrowings. After the borrowings, I think before I'm done with the borrowings, I would have hit 5 o'clock and we'll just, rest it here. Since the session is just for 2 hours. There may be some other time I can complete the recording, not in a webinar, and share it. Just to manage our time. We said, as we already agreed, that wherever the time meets us, that's where we'll stop. So let's quickly do the borrowings. Borrowings. So for these borrowings, I want you to do it with me as much as possible. So for the borrowings, you don't just look at it from only non-current standpoint. You must look at it from both the non-current and the current. So these are the two of them that we want to bring in. This 76 and this 151. If you add the two, both of them together, permit my English, the total is 228 million. So we need to go to note 27 to fish out this 228 million, whether broken down or as in a whole figure. So let's go to note 27. Here you go. This is note 27. This is the balance at the beginning of the year. This is the balance at the end of the year. This movement, if you highlight it, is a total of 228 million. So what am I supposed to do? Analyze each of them one by one, one by one. So I'll start with the addition. So start with the addition. So addition of 366 million, that means we borrowed more money. Which of the camps do you think we should take it to? Is it a C? Is it an A? Is it an M? Is it a B? Is it S? We borrowed more money. It's definitely a cash inflow, because when you are borrowing money, it's very sweet to collect that money you are borrowing. It's to pay that voila will start. And since it's a borrowing, it's clearly a financing activity. So we'll come to our statement of cash flows under financing. We'll say additional borrowings. Link it to note 27.3. Since it's an inflow, it will appear as positive. Positive 366,612. That has been brought in. The next item that make up that 228 million is the 91,759 of interest charge during the year. So, ladies and gentlemen, which of the columns can we place this interest charge during the year? Is it a C, a cash inflow or outflow? Is it A, an adjustment used in deriving profit? Is it an M, a movement in working capital? Is it a P, or is it an S? Let me see what they are saying in the chat box. So everybody is saying, most people are saying A. And to the people saying S and C, I corrected this earlier. So S and C is not correct. And the reason why you're saying S and C is because you think this is the interest paid. This is not the interest paid. The interest paid is here on its own. This is the interest charge for the year, the interest expense for the year. Remember that you can owe somebody 10 million naira. Out of that 10 million naira, you only paid 7 million. So the amount you actually owe the person is 10 million, but the amount you paid is 7 million. That's the same thing. The interest charge is the amount you owe for that year. But the amount you paid is 105. Possibly this 105 includes interest that's relating to previous period. It may even include prepayment of interest if the agreement allows such. So that is why the interest paid and the interest charge for the year may not necessarily be the same every time. So because of that, this interest charge for the year is not the interest paid. It cannot be a C, neither can it be an S. The best bet, it is an A, an adjustment. Because it was used in getting profit, and it is not the actual interest paid. Therefore, we must adjust for it. It is a non-cash item rather. So it's an A. Those who said A, you are correct. So we'll bring it here to say interest expense. Note 27.3, 91,759. It was deducted before, so we have to add it back. 91,759. We have evaluated 366. We have evaluated 91. The next thing, let's evaluate for 124,361, which is the principal repayment during the year. So if you repaid principal of 124,361 during the year, which of the columns will it fit into? Is it a C, a cash outflow or inflow? Is it an A, an adjustment for non-cash items? Is it an M? Is it a P? Is it an S? I think it's very straightforward. Most people already got it. Is it a C? It's an outflow because you are paying principal. So if it is a C, an outflow, which activity will we find it? Which activity will we find it? Thank you. Is an F, a financing activity. So under financing, I scroll down to financing, principal repayments, principal paid during the year. Still the same note 27.3. Since I'm paying it to be an outflow, so it must appear as negative. By so doing, I've evaluated this 124. The last one I want to evaluate is this 105, interest paid. So the interest paid, what do you think? First, is it the camps? Remember, you must associate with the camps. When you are now done, you now say, okay, which activity? That's just the summary. Thank you very much, Mr. Ibrahim. You gave me the answer I was looking for. Everybody who said C, you are correct. Everybody who said S, you are correct. But Mr. Ibrahim now went a step further. You know those people that win prizes. He said it's a C or an S. The person who said A, you are probably mistaking interest paid for interest charge. They are two different things. It's the interest charge that is an adjustment. The interest paid is not an adjustment. It's either a cash outflow or a specific cash outflow to be disclosed. Since we have assumed that and we have agreed that interest paid, like dividend paid, can either be a C or an S, which of the activity can we take it to? Is it operating? Is it financing? Is it investing? Yes, I'm seeing most people saying F. You are also correct. Thank you, Mr. Yusuf Abdul Fatai. It's either an O or an F. Thank you, Mr. Abdullahi Abdul Karim. Thank you, Mr. Anthony Chimaubi. It's either a financing activity or operating activity. Remember, anyone you pick, you must be consistent with it year in, year out. So this 105 will come under your interest paid. And interest paid usually come after the movement in working capital. So you have interest paid. I'll pick operating. I like putting under operating so that I can demonstrate how solid the operating activity is. So by so doing, if you see we have painted all this for green, it means that this 228018, which is the movement in this borrowing, we have brought it into the statement of cash flows logically. Scattered. It is scattered all over the statement of cash flows, but we have brought it in logically. All right, by my time is 5:08. I think I'll just pause here. I'll stop the webinar for here rather, not for here. I'll just stop the webinar here. We promised 2 hours and we respect people's time. So this is how much and how far we can go. For those interested in joining our training, which is starting next week, the management accounting training, let me just show that again. Here it is, where you will learn how to prepare management account practically. Do not hesitate to send the chat to those numbers you can find on your screen. It will be a practical session, and I'm sure that you even learn much more than you have learned in the last 2 weeks in this statement of cash flows training so far. Thank you very much for attending. The Excel document will also be shared with you. So in this document, I already have the completed statement of cash flows here under the direct method and under the indirect method. So you can, at your free time, go through it, understand it properly, and see how you can apply it to your day-to-day work. You'll find here that under the direct method, the cash flow we got was the same thing with the cash flow under the indirect method. And you'll find that everything here is linked. Nothing like I burn iron to iron. They call it JOMO. There's nothing like JOMO here. So at your free time, please go through it and enjoy yourself. So let me take a few questions till 5:30 because I have something to catch by 6 o'clock. No, not by 6 o'clock, by 7. So I have to be on my way before that time. So let me take questions for the next 20 minutes. And for the recording for last week, we know that's already ready. So you can pick it from our YouTube channel, Accounting Yard. Let me take questions. Some persons have their hand up. And I'll also take that Mr. Godson's question. Mr. Johnson, you have the mic.
Okay, thank you, sir.
Yes, sir.
I want to ask about bank overdraft. In cases where a company receives a bank overdraft, how is it accounted for in the statement of cash flows in terms of the inflow and the balance, the reporting balance? How is it accounted for and reconciled?
So an overdraft will be part of your cash and cash equivalent, but it will be under current liability. So that inflow, you will not see it in your statement. Or it's just like when this inflows into your cash, you don't find it into your statement, you see it in your statement of cash flows. So it's more of what those monies was used for. That's what you find in your statement of cash flows. So the eventual inflow to make it overdraft and all those things, you may not, well, depending on what you use it for, you may find it more under operating activity, right? But the closing balance will reconcile to what you have in your current liability as an overdraft. What I'm saying, I think it will be better practicalized than explained. Of the class, do you have an example that we both can work on so you understand it better?
Yes, I have.
Okay. You have my number, ba?
I believe you will drop it in the
So
WhatsApp platform after the
let
class.
me, let me just drop it. It's inside the chat box. We can chat better and we
Okay,
go through
copy
that
it.
specific one. Yeah, that you're having a challenge with.
Okay,
Yeah.
I will do that. Thank you very much.
Thank you, sir. Mr. Godson, I don't know if you are still around so that we can treat that your question and hopefully your network is better.
No, can you hear me?
Yes, I can hear you.
Yeah, good evening once again.
Good
So
evening, sir.
I was trying to ask a question on contract liabilities.
Okay.
So I was saying that, so we sell gas, let's say, assuming we sell gas to some customers, and so for them to receive that gas, they have to build the facilities. So what they do
So
that,
hold on.
they
Hold
build
on. Let's
those,
take it.
they build
Let's
those
take a step.
facilities.
Let's take it step by step. You sold gas. When you sold gas, you probably debit your trade receivables, have you?
Yes.
Now, when you debit your trade receivable, let's say it's debit with 10 million, where do you credit?
So we credit is it for the sale of gas?
Yes, for the sale of gas.
Okay, so now we credit the contract liability. That's a portion of the gas of their that the cost recovery that they want to do, that the customer want to do. So credits.
Portion now goes to revenue.
No, we debit contract liability with the portion that of the gas that they want to recover, a portion of the cost. They will not credit taxes and credit gas sales.
Okay. Maybe VAT. But initially, let's just assume numbers. Initially, before those items, before they entered this contract liability, what happened? How did they enter the contract liability?
So what we do is that we debit asset or work in progress ledger, then credit the contract liability. As as the customer is building, our team, a team from my company and their team will do what we call cost reconciliation. And so when they bring in those costs, they will not debit a work in progress and credit the contract liability.
So you are selling gas to them, they take the gas, and what do they go and do with the gas? They sell it to the end user or a customer.
So they use it in their factories.
They use it in their factories. Now,
that for production, yeah.
Yeah, in the process, at
Yeah.
what point do they now pay you?
Huh?
So at what point do they now pay you?
So they don't pay back.
Okay.
So they will start recovering it small through gas sales. Let's say if you sell them 10 naira, 100 naira gas, they'll recover something like 20 naira out of the 100 naira.
So for them to be recovering, that means you owe them money before.
Yes.
Okay. So if you owe them money before, that means there must be something sitting somewhere, maybe like a liability showing that you owe them the money. Abi? Hello? Yeah, I think I will need to call Mr. Godson outside of this call because that transaction, I am interested in understanding it. Mr. Godson, I will throw my number into the chat box again. Please, 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 don't hesitate to send me a chat. Today might not be a good time. After I leave this session, I might have a couple of places to go before reaching home. So maybe from tomorrow after church or Monday, I would like to understand that scenario better.
Hello, can you hear me?
Yeah, Mr. Gossin, I just thrown my number into the chat box. You can just reach me on WhatsApp.
Okay.
Yeah,
Okay, thank you.
yeah. Let me see the chat box. Please, what is the time for the virtual management account course? Yeah, on Saturdays, it runs from 10 a.m. to 3 p.m. and on Sundays from 1 p.m. to 4 p.m. Both virtual and physical participants, it happens at the same time. So you are joining virtually on Zoom or you are physically present here at our facility. So the facilitator talks to the same participants at the same time. Mr. Kinde said, how can we recognize the fast tax asset and the fat tax liability in statement of cash flows? Like the name implies, the fat tax they don't involve movement of cash, so you cannot find them in the statement of cash flows, except they were used in determining the profit for the year. Except that you will not see them under the statement of cash flows. Mr. Anthony says, is it the same cash flow that the bank normally requests for giving out a loan? No. What the bank requests for is a cash flow forecast, a financial model. This one is statement of cash flow of historic transaction. So this statement of cash flow of historic transaction can go along with the cash flow forecast. But what the bank is interested in most times is the financial model that forecasts, cash flow or a profit into the future, along with the historical records. But this is your question. I have a feeling you are referring to the cash flow forecast requested by banks. Madam Augustina Jonathan, I think she's asking the same question as Mr. Kendi. Since you are asking the same question as Mr. Kendi, I think it's just proper for me to handle the tax on the statement of cash flows. So Madam Augustina and Mr. Kendi, please confirm that you are with me and you can see my screen because I want to show the how the tax will be treated. Yes, the time for the training, it is starting next week, 11th of October, next week, Saturday, and it will run till 2nd of November. So I want to be sure Mr. Kendi and Madam Augustina are following. I want to show you how tax will be brought into that statement of cash flows. So the tax now, you have the deferred tax liability, and you have the current tax liability. Together, the two of them, you find that they are 156,030. Look at it. And where can we find this 156,030 in the notes? Note 16.2 and note 16.3. So I'll go to note 16.2. So now when you want to bring in the tax into statement of cash flows. It's the same, approach that we typically take. If we look at this deferred tax liability, for example, now the first thing is the opening balance 717, and then it's 2883. So you have the charge for the year from a profit or loss standpoint is 0, and the charge for the year from an OCI standpoint is 2166. You can completely ignore this. Remember that the only time we bring adjustments to the statement of cash flows is if they were used in determining profit or loss. Therefore, typically this OCI item will not come to the statement of cash flows. So by so doing, we are done with assessing this deferred tax liability. If we had a figure in this profit or loss, we would have, as usual, brought it under the operating activities. Now to the current tax liability. You have an opening balance of 279, and you have a closing balance of 120. You have a charge for the year of 124. So again, you ask, which camps does it relate to? Without wasting more time, it relates to the A, an adjustment for non-cash item. Was it used in getting profit for the year? I'll check my income statement, and you see that the 124 was deducted in arriving at this 185. What does that tell me? It tells me that it's an adjustment for non-cash item, because that is not the actual tax paid. So I will say tax expense for the year, note 16.3. I'm adding it back because it was deducted before. And that's this 124. I can paint it green. The next guy I need to assess is this 282, which is the actual tax paid. It's just the thinking is just how we thought about it when the thought process is just how we thought about it when we were treating interest expense and interest paid. It's the same thing here. This is tax expense, the amount you owe the government, and tax paid. This probably includes prior year taxes, something like that. So we have paid more than was owed for this year. So this tax paid, it falls into C, cash outflow, and also S, specific cash flows to be disclosed. And you typically find it under the operating activity as required by the standard. So you come under interest paid and you say tax paid. And it will appear as a negative figure. And by so doing, we are done with bringing in the tax. You find out that the only time the deferred tax will affect the statement of cash flows, remember, the only time it will affect the statement of cash flows is if the movement in the deferred tax was used in deriving profit or loss for the year. Otherwise, it has no business in the statement of cash flows. Take note of that. Another hint to also state is that if, for example, I started with profit before tax, there is no need for you to add back tax because you already started with profit before tax. The profit before tax was derived before tax was considered. I don't know if you get my point. Tax only came after it. So if you're adding back tax again, you'll be doing it's like double counting. So if you use profit before tax here, you don't need to add back this tax expense. That's what it simply means. That was to answer Madam Augustina and Mr. Kennedy's question. Let me see. Let me take people who have their hand up. Let me start from Mr. Emmanuel Okori.
Okay, sir. Can you hear me?
Loud and clear, sir.
Okay, good evening and thank you for the presentation.
Yes, sir.
My question was, I already dropped it on the chat box, but you didn't look at it. It's
Okay.
when we were analyzing the shares issues within the year, we went to the note 24
Okay.
and discovered that it was not enough to give all the information.
Okay.
And you only disclosed the amount paid. My question was, don't you think that we should have also disclosed the amount that was issued and not paid on
Sure.
that note.
Yes, I agree with that. I didn't bother with that because my focus was just to teach cash flow. If it was a proper financial statement preparation class, we would definitely have. When I was putting this down, I said something that there is a disclosure around issued and fully paid and issued and not yet fully paid. So those type of disclosures will definitely come in. You are very correct.
All right. Thank you, sir.
Yes, sir. Mr. Abubakar Olayiwola.
Yeah, good evening, sir.
Good evening, sir.
Yeah, thank you so much for the class. So, it's my question is about the kind of scenario whereby when you have a breakdown, initially as part of the process, you said you were going to find a difference that happened in the statement of financial position before now applying the accounts. So now let's now assume that, for example, retained earning. Let me just go straight from the
Okay.
example you gave initially. So you said in a retained earnings, so the breakdown was share capital, equity, share capital, retained earning.
Okay.
So the breakdown is opening balance profit for the year, dividend declared. So now, and you said that for us to bring any of these items to the statement of cash flow, so there must be items that they must be cash items in summary. Let's now assume that this dividend declared and paid was not paid. So now, how are we going to do that to ensure that the cash flow balance? Because our aim is
Great.
to ensure that the total that we are having here should match with the difference in the statement of financial position.
Thank you very much. I like that question. So, if this was not paid, for the sake of disclosure, I will just create a soft disclosure down here to say I can just put maybe a small star here. And I'm saying this how I would have done it in real life, not even because I'm teaching. I'll just put that asterisk, and I put 2 asterisks here to say dividend out of the 10.49 million declared, only 5 million has been paid during the year. Or, like the scenario you just painted, only nil or no dividend has been paid during the year. So that means everything we are still owing the shareholders. Now, if indeed we are still owing the shareholders, somewhere in the trade and other payable, there will be dividend payable here. So what it means is that it will form part of the movement in trade and other payables here. So what that will now mean is that 10 million that would have appeared, the 10 million that would have appeared here in brackets, you will now need to minus it from this line. So we'll now have something like this, minus that 10, whatever, 10, 489. Of course, I would have linked it. This is just example. So this is what we would have done. You understand?
Yeah, I understand.
Yeah.
Yeah,
But
thank you so much.
because we have paid for it, we are not going to adjust it against the payable. We can adjust it straight here and show it as a financing activity. It has to come in somehow.
Okay.
All right. Let me see. It's 5:30. People shall want me to miss. Okay, let me take one more question and we'll call it a day. Mr. Aziz Musa, I think he just raised his hands up. Okay. But anyways, I've included my number in the... No, Mr. Felix, 8 a.m. is not 8 a.m. on Sunday. It is Saturday, 10 a.m. to 3 p.m. On Sunday, 1 p.m. to 4 p.m. 1 p.m. after church to 4 p.m. For the venue is at Anthony Village here in Lagos. It's an Ajao estate. It's not the Ajao estate in Airport Road. It is the Ajao estate here in Anthony. There are 2 Ajao estates. There is a popular Ajao estate in the Airport Road. But the Ajao estate we're referring to is the Ajao estate in Anthony. Let me take Mr. Babatunde Adigbola's question, then I will need to jump and rush out of here and fly out of here if necessary. Yes, Mr. Babatunde Adigbola.
Hello, sir.
Yes, sir.
Thank you for the presentation.
Thank you,
I
sir.
think one of the questions I actually wanted to ask has been answered, and that's the
Okay.
timing for the management accounts presentation.
Thank you.
Then there's someone who was asking a question relating to gas or no gas, whom you said should reach out to you later. I think one arm of the transaction is actually missing in what he explained, by my understanding, because when we are trying to know what to debit and what to credit, it actually showed that there's actually been a transaction earlier,
Exactly.
which we are not looking at, because I don't know how come we're going to be debiting
Contract
was it
liability.
hello?
Contract liability, you mean?
Yes, exactly. So I thought probably we're going to wind up then. That was why I indicated mine, because it really caught my attention, because I was just trying to rack my brain. What could this leg be? What could the other be? But what you were capturing was ordinarily supposed to be transaction that will reduce probably the liability. That is my kind of understanding. But since you said it's going to be discussed.
Yeah, the guy's network is not solid. What might happen is that maybe afterwards, you're on the WhatsApp group, huh?
Yes, sir.
Okay, so maybe after I've resolved with him, I can just paraphrase it and send it to the WhatsApp group.
I hope we're going to have the recording is also going to be on YouTube, you said?
Yes, sure. Once we upload it, we'll share it.
Okay.
Yes, sir.
Right. Thank you so much.
Yeah. Yeah, you too. Before I rush out, let me just take Mr. Aziz Amusa. Mr. Fatai Lawal, we can talk on phone. Let me take Mr. Aziz Amusa and fly out of here.
Hello, sir. Good afternoon,
yes, sir. Good afternoon, sir.
Thank you for the presentation.
Yes, sir.
Sir, I want to ask if someone has joined a one-man business, but by joining the one-man business, I found out that there's no proper recording of accounting transaction. And even though, as I'm looking at it, I'm the one designing the payment voucher, telling them petty cash and some other thing. So when I got there, it's something. It's something was somehow. So although it's a one-man business and they are just coming up, so with the little of my experience, I'm the one telling them what to do this, do this. We need to put an inventory in place, and please, the kind of guides you can, and in terms of taxation, even when I check their payroll, there's nothing like payroll because they just pay them hand in hand, and the kind of recording for their casual labor and this thing they mixed up with the staff and casuals. Please, I want a guide from you, sir.
That's a lot of work. What we can do, you have my number, Abi?
Yes, sir.
That's a lot of is a job on its own.
The thing is,
Even
I'm just starting as an accountant, so
no problem, it's fine.
it will guide me to as well. So
I understand. So let's talk better through WhatsApp from time to time, because it's not something that I would speak to you now and be resolved. No. As you are building it little by little, we'll just be working together until you get something. You get to a point where I will just leave you and say bye-bye.
Okay, sir. Thank you so much.
You have my number, Abi?
Yes, sir.
All right, great. Just send me a chat. I might not be able to respond today because I still have some
okay, sir.
activities.
Sir. Okay, sir.
Thank you.
Thank you so much, sir.
Yeah. Okay, everyone. Thank you very much, everyone, for joining. Grateful. Thank you for listening to me. Who am I that you gathered here to come and listen to? Thank you. See you next week in our training. Please don't forget to register for the training. Have a great week ahead. The Excel, the YouTube stuff will also be uploaded and you get to know once it is done. Thank you and enjoy your weekend. Bye.